Good morning. It is Thursday, February 6th, and the stock market looks like it's going to open relatively flat. We've had a pretty eventful 2025 so far. We've had periods where the market has really come down, pulled back, corrected, rotated. We've had some stocks that have really taken a hit, and some stocks are really working. Um, I wanted to take a look at the markets and see what's going on. I also wanted to look at the earnings that we saw get released yesterday, as well as the ones that have been released early today, as well as the ones that are going to come later today that are very meaningful, like Amazon. But so far, the Dow in 2025 is doing quite well. It's up 5.47 year to date, and that's really good. The Dow has really lagged the S&P and the Nasdaq in 2024 and 23. So it's good to see that it's off to a good start in the new year. When we look at the S&P, it's lagging the Dow a little bit, 3% up. I think we've seen some pretty good volatility early in the year. We saw a correction in some of those big stocks. And the big stocks still, a couple of them are still giving up gains, which is affecting the value of the S&P, and some stocks continue to rally up, but we will see how those play out in 2025. And the Nasdaq, which has more of the growth stocks, it is doing okay, up 2%. We are, I guess, finishing up the first week in February. So year to date, that's fine. It's had a phenomenal 23, 24. So it looks like it's going to do just fine, up about 2%. Small caps, what have they been doing? Up about 4%. It's not bad. And small caps are kind of a hard index to really read, or I should say, get a general conclusion on, because you have so many companies, 2,000 of them. Some of the companies in the Russell are doing fantastic. So I think that's doing just fine. I noticed a rally in Asia. In China, stocks rallied in what would be considered Thursday's trading. They're like a full day ahead of us, right? So looks like something happened in China that investors liked. What are they doing year to date? So year to date, the Shanghai is flat. For the 1 year, it's up 17.25%. We saw that big rally happen in September of 24, where the government really decided, hey, we're going to stimulate our economy, and it's going to really help all the businesses in China. And I guess they've held close to their highs that have come out recently in the last year. So that's interesting. I don't know a whole lot about Japan. I don't follow it all that closely. I don't invest in Japan, but it looks like over the past year, it's 8%. So that is that. Okay, so we have that. Crypto, I think Bitcoin is trading under $100,000 per coin. It's kind of hovering around that amount, give or take, $10,000. And I continue to buy Bitcoin dollar cost average whenever it trades under $100,000 per coin. So I'll probably buy some Bitcoin today and keep adding just a little bit at a time and seeing that value grow over time. It's done really, really well. Over last year, it's up 129%. So it's a really, really good rate of return. Year to date, it's only up 5.65%, but you've seen moments where it was as high as, 104. And I think it touched 109,000 at some point, but maybe my memory isn't clear enough. 105 is pretty darn good. You could have bought it $92,883 per coin. Interesting. So Bitcoin's been kind of hovering above 90,000 up to 105,000. And some good things are setting up for cryptocurrencies. So we'll see if they have a good year in 2025. I'm thinking that it's just going to keep going up. It's going to continue to go up, probably reach 200,000 at least by the end of the Trump term, but I'm probably thinking by the end of 2026. So we'll see. We will see how Bitcoin continues to appreciate. All right, so the markets are going to open. Well, at least it's green. Dow's expected to open a little bit green, S&P a little bit green, and then Nasdaq. All right. So that's what's going on with the markets at large. I've got a nice list of stocks that I wanted to cover. Most of these have announced their earnings, and I wanted to kind of go through my thought process and revalue these companies. But what stocks do you want to cover? If you want to put those in the chat, that'd be great. Chances are I was going to cover it anyway, but let me know what you want to cover. While you think about that, let's talk about the heat map. Where's the action at? Looks like NVIDIA. NVIDIA's had such an interesting, really 8 months. NVIDIA is one of the most valuable stocks, a superstar stock. And over the past year, it's up 83%. But really, over the last 8 months, it hasn't done a whole lot. It's down about 8%. So what's it going to do? Is it going to break up and go up to $200 per share? Is it going to break down and go down to $80 per share, which is more of what I think is going to happen? I think the valuation on this stock, it's worth more like $84 per share, and the market's trading at $125. As we see more data come out, we'll see where this stock goes. There is something that I'm going to share about later around Amazon. They announced after the earnings, looks like the stock sold off. Why did it sell off? I guess I could say it now. So our friends at Google sold off big yesterday because they announced their earnings after the market closed the day prior. And the market did not like that they're spending so much capital, and they have good reasons for it. Hey, AI is our main, I guess, area of growth in the future. So we're building up this data center, and we're going to spend a lot of money building up that data center. And investors are a little bit short-minded, or I should say near-term focused. And they're like, yeah, that's great that you're excited about AI, but we just don't like how CapEx is really changing your free cash flows. And we're not seeing a whole lot of positive revenue growth. And if you remember Meta, and for good reason, I think stockholders were right on that one. Meta was spending a lot on the metaverse, and it was exciting for them. And they started spending a lot of capital, and they didn't have a lot of revenue to show for all that expense. AI so far doesn't have a lot to show for Microsoft and Google. Microsoft announced last week, and their stock got taken down. So as we see Microsoft and we see Google get sold off, these two are what are referred to as hyperscalers or cloud infrastructure companies. AWS is the biggest. They provide public cloud services, which are GPUs, compute, infrastructure. So when you take an Uber ride, you're running on a cloud. You're running on a cloud that Uber puts that application on, and that can go on and on. That's just the way companies get their infrastructure. And the highest growth in the data center, no big surprise, is AI and the excitement around it. But there's excitement, and then there's how much revenue is coming in. So Microsoft announced their earnings, and they dropped. They dropped really, really harshly. Let me go to the 5-day. Yeah, it gives us, well, that's not quite as good as I wanted. So you can see this big drop in Microsoft. Microsoft's in blue. So they announced, hey, we're going to spend a lot of money in that data center for AI. And the market said, no good. So then Google came and said, hey, we're spending a lot of money in that data center for AI. No good. So our friends at AWS are going to announce Amazon that owns AWS, operates AWS. They're going to announce today. And it'll be interesting to see because Amazon did come down because I think the market's seeing that, okay, Amazon's probably going to announce, hey, we're going to spend a lot of money in the data center, building it up, CapEx and so forth. And I would say that they're probably the markets. I'm looking for a couple things. One, AWS is really smart. Amazon's really smart. Maybe they did not build out the data center with as much capital as Microsoft and Google. And if they announce that, hey, we're growing really well and we didn't have to increase our CapEx as much, this stock's going to fly up because the market's going to be like, AWS is better and they're smarter than Amazon. They're smarter than Microsoft that runs Azure, and they're smarter than Google that runs Google Cloud. So that's going to be the big news later today when Amazon announces, because most of Amazon's profitability comes from AWS, from that cloud business. So that's a big, big story. If you combine the market cap of these three companies, you've got 3 trillion and then plus 5 trillion. You got north of $8 trillion of market cap in these three companies. So these companies really move things. So that is a interesting story I'm following. And Amazon, I think, came down because Google got punished. Like, you're spending too much CapEx. Now, if this keeps happening where the market punishes these companies, these really great companies, for overspending, that might set a trend where, okay, Google, Amazon, Azure, AWS, they're going to need to slow down on their CapEx spend. I would think. That's my logic. But that's what I'm seeing out there. Hey, let me just say hello to a couple people. And Kiter, good morning. You want to look at ALGN? Most definitely. Sergio, good morning. Shadow Guy. So, Shadow Guy, good to see you. Long-term bond yields are dropping, huh? Interesting. I've noticed in my bond portfolio, it is going up in value. And, my bond portfolio, it serves to be stable. It doesn't go down a whole lot. It doesn't go up a whole lot. It's been going up. That's good. But it doesn't go up a whole lot. But it's good. I want it to be stable. I don't expect a 20% rate of return. I expect like a nice 6 to 8% combined rate of return, but it doesn't drop a whole lot. If we have bad conditions like rising interest rates, it's nice and steady. My stocks, on the other hand, like Google, I'm a big Google stock investor. I got shellacked yesterday. I got, kind of knocked on my butt a little bit. And I own Google and I own Uber, and Uber dropped quite a bit yesterday. It's showing up right here. So I had too bad I wasn't playing poker or something, because I had a pair of sevens. Not a strong hand, but a pair anyway. So yeah, and that's where bonds show up. It's like, hey, I'm going to be nice and steady. I'm not going to surprise you on a Wednesday and see your portfolio lose a little bit of money because two of your main stocks are losing money. I bought into Uber yesterday because it's just Uber is misunderstood. And I'll talk about that a little later. But there's a lot of green on this heat map. Look at that. Beautiful. All right, let me keep going here. So Mike, the dividend investor guy, you want to look at Qualcomm. You got it. And HAFN. Sergio, QCOM, Google, AMD. I got them. Yeah, I got two of the three. And then AMD, I saw some stories out there. Yeah, it'd be interesting to look at. Tomas, buenos dias. Mike, the dividend investor guy. I don't think anyone on here has Rexar, but this stock is hurting. I may get it worse here. All right. You're not going to give counseling a shot, huh? Well, Let's take a look at the stock and maybe we'll agree with you. Arjun, thanks for joining. Tomas, stay calm and buy Pag Seguro. Ooh, man. Maybe we do got to buy some Pags. Tomas, thanks for the comments. Android PC, good to see you, man. Shadow Guy, what is your ever bond yield right now? Do you track it? I do. It's hard for me to do it on the fly, but maybe I can look at that. I noticed that my bonds did pick up some value, year to date and this month. But I'll calculate that and I'll put it on Discord for you. Then Arjun, you like MasterCard. We looked at Visa, but we didn't look at MasterCard closely. All right. Good to see all of you guys. We're 11 strong on the live stream. Thanks for joining, everybody. Let me continue on a kind of a stream of thought I've got, and then we'll get into some stocks. So there's a lot of green aside from these red spots. Like AMD really sold off. AMD, no big surprise. They just don't seem to be on the right side of things. It's for a while it used to be AMD versus Intel. Can AMD rival Intel? Well, Intel is now really non-relevant. They're just a dumpster fire. So really the leaders now are Nvidia for sure, and then Broadcom. Some businesses like Qualcomm put up fantastic numbers that I'll get into. And so AMD has to focus on that data center, and they could be a substitute for Nvidia if they could execute on that strategy. But it just seems like they cannot sustain like good positive growth, and they can't generate cash, which is why I don't invest in them. Man, financial services really did well yesterday. Visa, MasterCard, Berkshire, JP Morgan. Looks good. Only one red spot, and I'm not sure what this is. Consumer communication services is, I'll show you in a bit. They still are leading. This is the number one sector for 2025, even though Google really took a hit yesterday. I'll take a look at the sectors in a bit. Healthcare had a good day. A lot of green here. Looks like yesterday Lilly had an up day. Pfizer had an up day. J&J. And looks like Med Device had a really nice up day. Biotech had an up day. And then utilities and real estate. Consumer staples, Walmart had an update. Costco had an update. So it was a pretty green day. Pretty green day yesterday. When we look at the sectors, I'm ranking these by year to date, and communication services, even though Google had such a bad day, that sector's still number one, 9.5%. And that includes Meta, which is having a fantastic year, Netflix, fantastic year, AT&T, ditto, and others in the space are doing really well. Healthcare, 8.2%, materials, financials. So those are the sectors that are so far showing that they've got stocks that are really, really doing well. And technology lags because there's been a little bit of a rotation, and technology has cleaned up over the last couple of years. So the prices may be really expensive, and investors are probably taking some gains, putting those gains into another sector like communication services, healthcare, materials, and so forth. So that's what's going on with the sectors. And I'll continue to monitor this. I think this I like looking at this because I think macro level or high level, you could see, what they've done over the last year. And some of these sectors historically have done really, really well. So I like to see if maybe there is a sector that is unappreciated, forgotten, and there's probably good stocks in there that are discounted. All right. So the big valuable stocks, Apple was down a little bit. It's down for the year. All right. Microsoft, as mentioned earlier, it had a really bad last week. and it's down for the year, 2%. Nvidia down for the year. It had a good day yesterday. Amazon's up for the year, and we'll see how their earnings announcement goes later today and see if they are going to continue to rally or if they're going to be beat up like Google was beat up and Microsoft was beat up. Speaking of which, Google dropped, 7% on a $2.4 trillion dollar business. Market cap wise, that's about $170 billion of investment left Google yesterday. It left and it went into bonds, cash, other stocks, and that's a big number. Then you have Meta. Meta's just getting it done. Look at that, 20% rate of return year to date. They've had a lot of things go their way, but they've also operated an excellent business. They've invested in AI, and their AI app looks great. It could help them with their business. There's certainly, a value from AI for Meta applications like Facebook, Instagram, and so forth. So that's looking good. It's looking good for Meta. I think they're set up really nicely. Tesla down for the year. Broadcom even. So that's where we're at. Other notable names: Walmart getting it done, 13% because it's a staple. JP Morgan, wow. Visa, excellent. And Visa is so darn consistent. Good job, Visa. All right. So today, the big name announcing after the market closes is Amazon. Eli Lilly announced before the market opened. Just a lot of big announcements today, 180 of them. Yesterday, after the market closed, we had Qualcomm, ARM Holdings, PayPal. So let me get going on some stocks here. I'm going to start with PayPal, which is, I haven't looked at PayPal, and all right, so it looks like they had an earnings beat last night. And let me take a look at their actual financials. So there's the webcast. So latest news, here's the results. So PayPal, 3 years ago, the stock was much higher than it's at today. And the stock has been kind of less desired than in previous years. It is a company that really specializes in partnering with companies so that it could be the payment system on websites. That's primarily their main business. So they do that quite well. They also have a couple businesses that are thriving, but they're smaller. The Venmo business, where it's peer-to-peer payments, that's really popular. The other business that's growing quickly is the buy now, pay later business. That's growing really nice. So that's looking good. And they have a crypto business where they have their own coin, and they're going to continue to grow in receiving or being able to administer cryptocurrency payments. So the business is, I think they've got some businesses that can grow in the future, and their core business continues to expand as well. So for the fourth quarter, looks like net revenues increased 4%, slow growth. For the full year, their net revenue increased by 7%. So slow growth. That's what's expected from PayPal. They are fairly big now, so it's hard for them to grow. All right, looks pretty decent. Cash flow. So for the fourth quarter, free cash flow is 2.2 billion. And here's you see their cash from operations is 2.4 billion. They don't have to put a lot of capital expense into their business, so they get to keep most of it in the form of keep free cash flow. Very good. Free cash flow for the full year, $6.8 billion. That looks really good. Good job. PayPal, free cash flow, $6.8 billion. They have cash, $15.4 billion of cash. Very good. And debt, 11 billion. Okay, so they're going to guide, looks like Q1 and then FY 2025. So this is their guidance. And this past year, so for the full year, earnings per share was $3.99, non-GAAP $4.65. So they're going to grow that. They're going to grow from 399 up to 480. That's really nice expansion. That's like 25% expansion. And on the non-GAAP, it's going to be a nice 10% expansion on that. Very good. That looks really good. Okay, so now we're going to get into a lot of ratios here. Volume growth did grow. Net revenues, okay, good. We went over that. Net revenues are in the mid-single digit, 4% for the quarter, 7% for the year. Hopefully they give me a nice financial statement here. Okay, here's the balance sheet. Looks good. They have more cash than debt. Here is their income statement. Nice and profitable. Here's the statement of cash flows. So here's the full year. Cash from operations expanded from 4.8 billion to 7.4 billion. That is great growth. If I look at the lines up here, here's the buy now, pay later. Okay. So, and what they're doing is they're doing the transaction with the consumer and then they sell the debt. And they have this partner. I forgot the name of them. It's one of these big financial companies that buys these loans because that's what they are. And they're issuing them out to negative cash flow. And then they're selling them. It's a positive cash flow. And here's the negative. Here's the positive on the buy now, pay later program. That's going to continue to expand. And for a while, PayPal had their cash flows really affected by this because they didn't have that partnership in place where they were selling the debt, but now they do. And I think if they keep that in place, it'll continue to not affect their cash flow. But it's a positive on the top line growth, which is good. Okay, so that looks good. See that the CapEx number is pretty consistent. Now, PayPal is dabbling in AI. I'm sure that they're developing applications to help them make it easier to set up PayPal applications, the different variety of applications they have. But they're not overspending. It's just 683 million. So they get to keep a lot of that free cash flow. So the numbers look really good. Let me update my analysis on them, and then we'll take a look at and see what analysts have to say about PayPal. All right, so 2024 was, I think I've already updated this. So on 2024's number, I'm going to project that they're going to keep growing that number, and it's going to grow by 6%. It's heavily discounted when we consider that the cash that they generate is really high. You can see this cash flow. And this is not like an anomaly. PayPal's been a good cash generating company for a long time. And they're in a business like Visa, MasterCard, where they generate a lot of cash. So these guys are just really valuable based on cash, incredibly valuable. And based on earnings per share, which is this where they're guiding, they're also very valuable. So they're discounted by 21%. I think overall they're discounted by 85%. And analysts on stock analysis think they're discounted by 14%. So this is a nice discounted stock. I own a fair amount of PayPal. And to me, it's the price target that I have on them is $146 per share compared to $79 per share. I think they're set up well. They have a lot of good future ideas. Buy now, pay later, crypto, Venmo growing. Those are the growth catalysts for PayPal. And then they have their cash cow businesses that really generate a lot of good fundamental value. I think PayPal could also acquire businesses. They've been a good acquirer of businesses. So they can continue to do that and buy some businesses that are really going to be interesting. So PayPal looks really good to me. Today, stock market opened a minute ago. Stock's up a little bit. Year to date, the stock is down 7%, really sold off on the earnings announcement. Market did not like something about around their earnings. I think their earnings were really good. The market's a little, I think, I would say finicky. It's selling off for, I think it's trying to find reasons to sell off. And that's an expensive market for you. Like Microsoft, they found a pretty good reason to sell off. Google, good reason to sell off. Now, Palantir is the opposite. Has found a lot of reasons to buy, and Palantir thrived. But with PayPal, it really sold off, which was interesting. Not the first time. PayPal's really seen some really down days, and investors that bought into that pullback were rewarded recently. So I am probably going to start buying PayPal stock. I have a big position, but I just really like the situation with PayPal, and I'm going to buy some shares today. All right, so that's PayPal. All right, so since we're in financials, let's take a look at MetLife. Let's take a look at Snoopy's company, see what that's all about. It is down 3.27%. What is going on? Why is Snoopy's company down? It's breaking even for the year to date, pays a decent dividend of 2.63%, market cap of $57 billion. MetLife is an insurance company. They do a lot of life insurance and variety of annuities and investments of that type. They've been around for a long time and are a well-known brand in financial services. Their forward PE is 8.6. Wow. That's really low. It's a strong buy with a discount of 10%, according to analysts. Let's take a look at their earnings and see what happened, Snoopy. How come they're selling your stock off? I keep saying Snoopy because you guys may or may not know. Kind of like the icon that they've had for a long time is Snoopy, the little cartoon character. And I'm a fan of Snoopy, so it really, connects with me, and I've always thought of him because I think of Snoopy. All right, so what's going on here? So full year results, net income. So this is the profit was 4.2 billion compared to net income of 1.4 billion the year prior. So profitability really expanded. Book value per share was down 4% in the current year versus the prior year. That's a negative. Okay, I didn't see revenue on there. I'll have to find their income statement and take a look at that. Here we go. So total revenues. So for the full year, they did grow their business from roughly 67 billion to 71 billion. So that's 4 billion of growth. That's going to be about 6.5% growth. Actually, they give it to me here, 7%. So that's correct. Although that's just looking at this number. So that's about 6.5% rate of growth on top line revenue. Looks like their premiums are fine. They grew a little bit, but their investment income expanded. That makes sense because you have higher interest rates. So if these guys are accepting premiums on life insurance plans, and then they get to take that money and invest it in bonds, which are paying a higher yield, boom, that's where the income's coming from. Higher rates mean something for each company. In the case here, they're taking advantage of a higher rate. So, all right, so that looks good. Top line revenue looks good. Return on equity, 16.9. That's very good. The book value did drop. I don't value these guys based on book value, but it is something that I think is interesting, and it's not good that it's going down. All right, so top line revenue is better. Now here they're breaking out the business. It's a global business. Most of our revenue is here in the US, but they also do business around the world. I'm trying to find the financial statements. Hopefully it looks like they have a nice long earnings report. So let me try to find where we're going to find the income statement. Here we go. So we're back to revenues. We covered that. We're good there. And these guys, they're an insurance company, but they're not going to be affected by these natural disasters like the wildfires in California or things like that. Or I think in the past 12 months, we had some hurricanes hit the U.S. down in the Florida area. They don't get affected by that. It's just an individual, life insurance plan. If the mortality goes up, then they would be affected. All right. So equity, they're giving us a lot of information, which is good, but it just kind of takes a while to get my sights on the right income statement that I want to look at. I looked at the top line growth. That looked fine. Boy, they really give you everything to get familiar with the business. So free cash for the full year, 4.6 billion. Okay. And last year it was 3.6. So a rise of 1 billion looks good. Okay. So we have a growing business that looked good. You have a growing business. They already loaded the financials. Very good. Nicely done. Stock analysis. So we have a growing business, 6.11% rate of growth. Free cash flows are expanding. So why is the market not liking this stock? That's a little hard to understand, or I'm a little confused, but the market is a little finicky. All right. Well, that's that. I believe this stock is discounted. It's discounted nicely. I continue to buy shares into MetLife. I bought shares yesterday. I've been buying pretty regularly, a couple of times a week, to try to build a position. Because those cash flows are really good. And somehow where did I get this number? I think my wires are crossed here. So they reported 4.6, but I think stock analysis had stock analysis was looking at their their financials differently. So let me change that number. So this stock overall, I think, is discounted by 25%. And it's an insurance company. It's been around for a long time, pays a dividend, really solid investment. So I continue to buy shares. I own shares in MetLife, Allstate, and those are the two primary insurance companies that I have. And I own Chubb, and I bought into Chubb recently, and I've got a good balance of Chubb shares. And insurance companies are just those businesses that are run, and just the businesses tend to be stable, continue to make more money over time, grow, and are a good solid um, stock that's going to do well. It's not going to be Palantir. It's not going to go up 300% in 1 year. You got to look for technology or other high growth areas to try to catch a couple of those. But this one here, if you want to grow your wealth in a more stable growth uh, process, MetLife is where it's at. This is a good stock to take a look at and invest in. So, MetLife, Snoopy's company, is being sold off. And Snoopy, the character, he's met adversity before. If you watch Peanuts, Snoopy's had to take on the Red Baron. And so the guy can deal with adversity. And hopefully, I don't know if everybody knows who Snoopy is. So I got to show you a quick image, and then you'll know what I'm dealing with. So here's Snoopy. He's cool. He takes on the Red Baron. Oh no, I don't want to buy anything. So you can see here, this is where he takes on the Red Baron. He uses his imagination. Here's where he's taking on the Red Baron. So then he's got his buddy, Woodstock. So this guy's been in the minds of Americans for my whole life. And I grew up watching this dude. So he's the main logo of MetLife. That's why I kept talking about this guy. All right, Snoopy. Hopefully the market treats your stock a little better than they've been treating. Oh, down 4%. So I'll buy some more. So that's MetLife. And let's move over to Allstate. As mentioned, I own Allstate stock. It's up 2.85%. These guys have been getting it done. For the year to date, 3%, 1 year, 26%, 5 year, 65%, and they pay a dividend. These guys are in second place to Progressive. Progressive has been the leader of the pack, but these guys have been a good stock for me. So, especially if you buy around, ranges where the stock's really nicely priced, which is where I bought, and then the stock really does well. So, Allstate is moving up 2.59%. Let's take a look at what they announced and see what they had to say. Okay, so here's their earnings release. So this is the 3-month. Here's a 12-month. Nice growth on revenue. 12% growth on consolidated revenues. Very good. Nice growth on book value per share. Catastrophe losses actually came down. And I wonder if they're taking a bunch of reserves for the problems in California. I'll do a search on that after I get through reading their financials. So very, very good earnings. Solid. Allstate's a very well run business. These guys sell insurance for automobile insurance, homeowners insurance, those types of insurances. You buy them from Allstate. Very good brand, good insurance, and they are growing nicely. And it's the fires in California as well as like the hurricanes in the South. Um, it's good news, bad news. It's bad news that hey, there's probably going to be a lot of claims, and they're going to have to pay some money on those. The good news is that they're going to have to raise premiums, and their revenues are going to expand. It's just the nature of the business, and I know the public doesn't like the fact that hey, why is insurance costs going up? If you look at homeowners insurance, especially, it is going through the roof. But you got to use a little logic. Home prices are really expensive. Construction rebuild prices for a home extremely expensive. The inflation in those markets is so high. Using logic, of course, an insurance company is going to raise their premiums because if they do have a claim, they're going to have to pay so much more money, right? So I know the consumers don't like it. The public, there'll be an outcry. Hey, these insurance companies are charging too much. Well, it's because homes are worth so much, and to rebuild those homes costs so much. And cars are super expensive now. Um, we have a friend that she and her husband, it's my wife's friend, um, just bought a new pickup. They like having a pickup is one of their vehicles. And they looked at the Ford line and they said that the best top of the line Ford F-150 with everything on it that's, really nice to have was $110,000. I'm like, holy smokes. That's a lot of money, man, for a truck. So they settled on a truck that was $60,000, 60. That was maybe the XLT, which is kind of middle of the road. Car prices are really expensive. So if you total a new car and Allstate has to pay it, the cost goes up. So good news, bad news. Yeah, the cost of claims is going up, but they get to raise their revenue because they have to charge more. All right. So for Allstate, I don't get fixated on their balance sheet a whole lot. I really want to know that they're growing their top line revenues. Check. They keep generating really nice free cash. Let's see if they provide that to us. Chances are they may not. No, looks like they're not. So I have to wait for that. I will have to wait to get a statement of cash flows. All right. So the stock is trading up. It's the expanding revenue looks good. Expanding book value looks good. Analysts think it's, go back to that, but here's Chubb, and then I think I have Allstate right here. So the stock is rising. Good deal. I own from the insurance companies I own more Allstate stock than the other two. So I am good there. I still think the stock is discounted by 34%, even with the current stock price. So I'm good where I'm at with Allstate. I've got a very good size position. I've invested in it for a while. Chubb is a smaller position. I like Chubb, really good fundamentals. And I like MetLife. And MetLife's different than Chubb and Allstate. MetLife's really into life insurance. I made good money on Prudential. I owned them for a couple years and then sold them. And they're a lot like MetLife. And I'm hoping that I have the same success with MetLife. Eventually, today it's selling off, but it could be an opportunity to buy into MetLife. All right, so Allstate's looking good, looking real good. Good job, Allstate. All right, let me look at what the market's doing, and then I'm gonna get into some of these requests that you guys made, so I don't keep you guys holding too long. Thanks for hanging in there with me. Got 11 people on the live stream. I appreciate it. Thank you. All right, so let's take a look at the heat map. All right, so NVIDIA continuing their rise. Microsoft, Amazon, hey, beginning to rally a little bit. That looks good. And Meta continues to go up consistently. Google still still bleeding. The bleeding has slowed, but still giving up some of its value. Lilly is really green, but the rest of the space is red. Interesting. What's driving down the stock values in healthcare? All right, so that's where we're at. In higher context, like let's look at the indexes. So the NASDAQ's up 20.2%, S&P's up 0.24, Dow's up just a tiny bit, 0.05. So it's a green day, but a little bit flat. All right. And I think Shadow Guy was looking at bond yields. So it looks like bond yields are rising. And looking at the 10-year. So this is a good day to buy into bonds, because when these yields go up, it means the price of a bond gets discounted, reduced. When we look at the 10-year and kind of look at the past year, the rates have been dropping, but they are still on the high side, right? We had a nice low interest rate period in September, and then interest rates rose. Now, when the market's scared is when these rates will drop. We have seen a little bit of fear in 2025, but again, the rates are still relatively high. We look at the 5-year, see how we really went up in rates. The market was just cranking along in 2021. 2022, as the rates really expanded up, the market sold off. And they've stayed up here for a while. So mortgages are expensive and so forth. Now, as an investor, I want to continue to, the way my bond portfolio works, I have some bonds that are redeeming, meaning the end of that agreement that I lent a corporation or a government some money, they pay me an interest rate, and then they return the capital. I'm getting capital returned to me. I had on February 1st, I had one of my bonds redeem. I got the capital back. And next week on Wednesday, I'll get one of my bonds is going to redeem, and I get the capital back. So I'm looking to buy into bonds to kind of refill that portfolio bucket of bonds. And I've been doing that through ETFs. I also buy individual bonds, but that takes a lot more effort. And I realized that, an ETF is probably going to work better for me. So I'm probably going to buy into that ETF since rates are rising and bond prices are lower. So I'll buy into that today and continue to fill that bond bucket. What I like to do with bonds is try to have the next 5 years of my living expenses covered. And the market can really begin to crash, and that bonds would probably go up in value. My next 5 years of expenses are covered. I don't have to worry about that. I can just focus on taking advantage of a dropping market and wait it out and figure it out over the next 5 years. So that's where bonds are going. So that was one thing that Shadow Guy brought up. All right. So market's relatively flat. We're seeing some companies, individual companies, do quite well, like our friends at NVIDIA. Qualcomm really selling off. I think the ding on Qualcomm, and we can look at that next. I think it was a request, is the lack of data center revenue. I acknowledge that. I just think the data center is being overplayed a bit. And I think the symptoms of that is Google, hey, we're spending a lot of money in the data center and the market sells off its stock. Microsoft, we're spending a lot of money in the data center. Its stock sold off because the market wants to see, okay, I get that this AI thing is going to be interesting, but interesting doesn't pay the bills. Show me revenue. And if you can show me revenue, that's great. They can't show revenue right now. They're like, well, we're spending a lot of money, but we don't have a lot to show from it. Then that's a problem. As that slows down, I think the data center is going to slow down. So I'm okay with Qualcomm. I'll continue to buy into it. I'm doing well with it. It's a good stock. Let's take a look at it. Okay, so Qualcomm down 4.6%. Year to date, it's up 9%. Over the 1 year, it's up 18%. So it really dropped down around the June timeframe. I started buying here, and more recently, the buying was really good. You could have bought the shares at $150 per share. The company is doing well. Their growth was good. It looks like they loaded the most recent quarter. 17% revenue growth. And Qualcomm is tied to smartphones, and the top Android devices that are made by like Samsung and others, they use Qualcomm chips, and they've been expanding into automotive. Automotive, I mean, I think you guys probably own newer cars. I know Shadow Guy just bought a new car. My wife and I just got a car here in November. Really impressed. The technology in cars is really impressive. Well, Qualcomm's really grown in the automotive sector as well as other sectors because they used to be like 100% in smartphones, which was not a bad place to be, frankly. And they're growing in PC sales, or Snapdragon chip is actually really good for AI based computers and laptops. So Microsoft's chosen Qualcomm Snapdragon for one of the chipsets that they're going to use in their PCs as an example. So they are diversified, but they're not in the data center. And I think that's what investors are like, hey, you got to be in the data center to be an attractive semiconductor company. Hey, I'll continue to buy these guys. You grow at 17%. I continue to buy in the quarter. And then for the year, they're growing at 12%. They had a pullback year in 23. This is semiconductor. So you have these pullbacks. So this stock, I think, is going to continue to perform, and I'm going to continue to buy. I think their free cash flow, let's take a look at that. So gross margins are good. And free cash flow, nice expanding free cash flow. Nicely done. Upward chart, that's what I want to see. So free cash flow looks great. Growth in revenues at 17%. They're already a large company. That looks great. So I will buy more Qualcomm today. I have the stock discounted nicely. I'm going to look at a couple figures and then I could go update my analysis. So they have $14.3 billion of cash, and they have 14.58 of debt. So they can almost pay off all of debt with their cash balance. Okay, we're good there. Taking a look at Qualcomm and seeing where I think the stock is, what it's worth. So their free cash flow was higher than it was in the trailing 12 months as an expectation. It's growing nicely. So I'm going to update that number. So good growing cash flow. That's always good to see. So the forecast, I'm growing cash flows by 8%, and then terminal value growing them by 4%. They're in a really good market. Smartphones are not going to go away. Actually, the workload on the smartphone keeps getting more difficult. You think about AI is supposed to put some apps, like the most highly downloaded app now is DeepSeek. And that DeepSeek app is going to need more compute, faster chips. And with that in mind, I think Qualcomm is going to see good demand there. And the cash flows are phenomenal. And then the company doesn't have too much debt. Very good. They could acquire another business if they took on leverage. They tried to do that recently, but that acquisition didn't pan out. Or I should say it was more of a rumor. It's a rumor that they were going to acquire Intel for their assets, probably sell some things they acquire the company and they're basically acquiring assets, and they sell some of the assets, keep some of them. That was a rumor. It didn't really go anywhere. And I think their cash flows are just really valuable. In fact, they have 92% more value than their current stock price represents. From a earnings per share perspective, how were their earnings per share, excuse me. So 25 analysts cover the stock. They say it's 22% discounted. Worst case scenario, the stock can come down 160. Best case, 270 is a high point. I'm closer to the high point on my valuation. And they're going to grow revenues nicely in 25, single digit in 26, and then 27. You see that cyclical nature of this business, grow or industry. Expand, contract, expand, and then they're going to contract. So I need to figure out at what point will I sell Qualcomm. I think once the market really cranks up the stock price, maybe it goes up 50% from here, maybe 75, I would think about exiting. I've done that with semiconductor, and I've done it successfully, so I'm going to keep doing it. Earnings per share for 25, $11.43. Okay. Growth rate of, I'll use like 7%. 6% is fine. So 72% discount. So if I see this stock, my price target is going to be 287. And if they keep performing like they're doing, 17% growth rate, then the stock's selling off. I'll take a discount. Thank you, stock market. I will buy more Qualcomm. So Qualcomm looks good to me. Their earnings look good. Stock market's selling it off. I'll buy some more. My best estimate is the market will rally this stock, and 6 months to 18 months later, the stock will be worth $200 or be priced at $250 per share. Once it reaches this price target or gets close to it, and based on where they are in their cycle, I believe that semiconductor cyclical, I'll probably sell out of the position and then start over again with another semiconductor stock. All right, so that is Qualcomm getting beat up today. I don't think they deserve it, but I'm just one investor in a stock market that has millions of investors. So that's just the way it is. All right, so Tesla keeps selling off. I don't think Tesla is doing all that great. Salesforce is selling off quite a bit. There's probably some bad news out there. Of course, Qualcomm's selling off. AMD is selling off. All right, since we have semiconductor in the brain, let's talk about AMD. So AMD's, I've covered it a few times over the last couple of weeks. They just aren't a really attractive company to me because of their lack of free cash flows. And over the last year, man, these guys have really taken a hit. $178 billion market cap. They've had moments of really nice appreciation on their stock coming out of 2022. They really did well. I mean, you pretty much tripled your money, and they've really given up a lot of those gains. When we look at their revenue, they had good growth, 13.7%. They had a contraction in fiscal year 2023. And see, their free cash flow is anemic compared to Qualcomm, Broadcom, just doesn't even show up. They're a really high revenue company. They only produce a little bit of cash. It's like, what am I not getting here? Why do you not have? I mean, it's a mature business. They've been around for a long time, and they can't produce free cash flow, which is my biggest worry with the stock. So the revenue looks good. What do analysts think about the stock? So 27 analysts cover it. They think it's 52% discounted based on earnings per share. I don't doubt it that earnings per share is probably going to look good. Worst case scenario from one analyst is they're fairly priced. Best case scenario is they're going to more than double in value. They're expecting the company is going to continue to grow really nicely. Man, how's the market abusing the AMD stock so bad when the revenue is growing so well? There's probably a story out there that they're just not getting it done in the data center, and that might be the reason why it sells off. Remember that stocks in the near term, it's a popularity contest. It's a voting game. Oh, investors are voting that this is the cool stock. Palantir is super cool. Coolest stock in the stock market. Over the long term, investing is like weighing the value. I weigh the value in free cash flows principally and use earnings per share as kind of 1/3 of what I recognize as true value. And I set my price target and make my decisions. AMD is not popular right now. And I think the story that they're not competitive in the data center is showing up. The other story that's hurting them, I believe, is we once had a semiconductor industry that was the technology companies were dependent on NVIDIA, Intel, AMD, and they would kind of co-develop chipsets for particular use cases. Well, those days are kind of leaving us because companies like ARM Holdings, they help companies design their own chips, and they circumvent, having to collaborate with AMD, Broadcom, Qualcomm, NVIDIA. They're like, hey, just design your own chips. For example, Google does that. And I believe that Google designed a chipset that Apple is using in a big way. So that is a big threat to AMD and other semiconductor companies, is if their value in their ecosystem gets taken away because companies, really smart companies like Google, Amazon, Microsoft, Meta, they start, hiring engineers, working with solutions like ARM, and then just designing their own chips, and they're going to own the IP. They don't have to pay AMD, NVIDIA, and so forth for their chip design. They could say, hey, we designed to the workload we needed, and we have the chip we need. We were in a new world. And then we go to TSM, and they have the foundry, and they manufacture it for us. So that's also a threat to AMD. So AMD is underperforming. I'm personally not interested in the stock. I don't think they generate enough free cash. Obviously, the trend is that the market doesn't like AMD. They feel like AMD is not a player. It's not a player in what is most interesting for semiconductor. And will it, catch the interest of the market again? It could. It's done it before. It just isn't a chart where it's gone up and to the right nice and beautifully. Like if you see some companies and you see that upward chart, you're like, man, that is really, really comfortable. Making a lot of money and just consistently going up in value. So that is AMD. Good luck with AMD. Okay, so I'm going to jump over to ALGN. Align Technology. So Align Technology designs, manufactures, and designs Invisalign clear aligners. Cool. I know exactly who they are. So I'm going to get in the time machine. 26 years ago, I helped Align Technologies implement their software, or select and implement software to run their back office operations. Back then, they were a tiny startup up in the Bay. Really interesting idea 26 years ago. So yeah, I know who they are, and I've been on site at their company. A really neat story behind the company. So I've kind of kept an eye on these guys because of my personal involvement 26 years ago with their software selection and implementation. These guys they were kind of really hot for a long time, but they've seen a lot of competition from other companies that create a similar product. This is a way to, primarily younger people that would like to get their teeth straightened. I'm going to use the word corrected. I don't know if that's the right way to express it, but and these liners will help you straighten your teeth rather than getting braces if you don't want to have braces. And cool. That's what they're at. These guys were like the innovator, and then other companies have come in that compete with them. Market cap's tiny, 16 billion. But I'm going to try to go in the time machine with Google because I think they'll give me a better chart. You see that these guys were valued a lot more and they've really dropped. And they've been around for a long time. They IPO'd a long time ago. So I called on, or I worked with them in like 2000. I worked with them like 2000, 2001 is when I worked with them. I was on site at their company. I'm sure they moved from that facility because there was a tiny little office. And they probably moved into a big facility because they became big, man. They were like worth a lot more. All right. So that's Align from historical perspective. The $16 billion market cap, revenue is $4 billion, and forward P is 22. Price target is 19, call it 20% higher than its current stock price. Their financials, they're growing single digit. So they're an established brand. In the past, they were just really growing. Look at this growth. Very nice growth. Then they hit a wall in 2022. I think other competitions come out. The competition, like in some healthcare categories, Hims and Hers is a good example. They come in and they have an alternative to a very popular remedy or treatment for a condition. In this case here is, you want straighter teeth, and other competitors have entered the market, which have really slowed growth. So that is one of the realities with Align Technologies. Single digit growth. And how could they change that? I'm not sure. Free cash flow looks good. Looks really good. 738. This is a mature business. Gross margins of 70%. Beautiful. Beautiful. So high gross margins, 738 of free cash flow. They're fairly priced. They're slow growing, so it's not like not. Yeah, they're fairly priced. Because if I took 738, maybe multiplied times 20 because of their high margins, but low revenue growth, I get to like 15 billion, assuming their balance sheets in good condition. And it is. They have 1 billion of cash, almost no debt. So it's in great condition. So I think they're fairly priced, and they're not really exciting right now. Investors are not excited about Align Technologies. 9 analysts cover them. Some analysts are very optimistic on the stock. It doesn't seem to be very risky because it's lost, some of its value. The stock price has really sold off over the past year. For the current year, it's been moving 9%. And over the 5 years, it at one point was looking like a genius move, right? If you bought at $200 a share and it went up to $700 a share. Yeah, looks awesome, but then it's really crumbled. I think it was that year where they had contracting revenues that really hurt the company. So this one here is a pass for me. I think they have a lot of competition, and I don't know that they're effectively able to beat the competition, expand their business fast enough. It's not exciting. They're not catching the market's attention, and they're going to be a slow grower for a while. So hopefully they do better. I'm a fan. Go Align Technology, but I don't think they're a good investment for me. So that's Align Technologies. A name from the past, from my past, my career in software. Hafnia operates oil product tankers in Bermuda. Yeah, we looked at this stock. High dividend. 25%. That is a lot of cash coming in to your account in the form of dividends, and it's held its value. So in general, this has been a good return for the 1 year. Over the 5 year, you would have been a genius to buy this stock because you would have bought it and you would have seen your stock value appreciate, and you'd be paid this massive dividend. Now, what's going to happen going forward? These guys, looking at the quarterly, still growing nicely. 10% growth. Looks good on the growth. And they make money. Their profits have been expanding. Their free cash flows look good. See, free cash flow per share $1.82. They pay a dividend of $1.37. They can afford the dividend. Their business is expanding. As you think about, if tariffs become the norm, where this country is going to start charging a tariff here or there, and oil most certainly will probably be one of those categories, you're going to have to ship product around the world, maybe longer distances, because, hey, I used to get my oil from a country, but they're charging me, or we're in a tariff war with them. So we're not going to get oil from them anymore. We're going to have to go further away to get oil from another country at a better price. And overall, it's going to be less expensive. Well, I'm going to have to pay Hafnia for the transport. So, hey, man, that looks pretty good to me. This isn't looking like a bad idea. They can afford the dividend. Some analysts think this stock can double in value. Worst case scenario, it should rise to $6.50, discounted by 55%. And how many analysts are we talking about? 2. All right. So just two analysts, but I would be the third analyst. And I think the stock looks good. Earnings per share look good in the current year. It's expected to go revenue growth. It's expected to slow. This is wrong. We just proved that the trailing is much better than that. When do they announce? So they're going to announce on the 27th of February. And not a lot of analysts cover this, so I'm not sure where they're getting this contraction, but I would chase that down if you're thinking of buying this stock. Like, hey, are these guys supposed to contract their business? Is it supposed to contract? Are they supposed to lose revenues? Try to get your finger on that, because that could drive the stock price down. The stock has been selling off over the past year, right? It was at close to $9. Now it's at $5. So that's a pretty good sell-off. So HAFN. So that's like a 40% sell-off from the peak. So the market's expecting these guys are going to slow down. They're going to have trouble with their revenues. So I'd want to make sure that was either overplayed, like, no, their revenues are going to be flat or grow. Well, then the stock's poorly priced. It should be higher. And they pay that massive dividend. So there's some homework involved, but I think there's opportunity in that account, or that stock, that if the market has it wrong, or if maybe there's a story that isn't correct, like, hey, these guys are going to keep growing, this isn't a bad stock to consider. The PE is super low. The tension in the world is, and I don't know that the oil industries are going to be all that affected by the tariff war. It's going to be more like product based, like products we find at Walmart, or tangible products like cars. But who knows? Maybe the tariff wars do affect oil, and more shipments on Hafnia need to be done because of the tariff war. That could be a catalyst for Hafnia, a positive catalyst. Interesting. Good luck with it. Somebody asked about it. I forgot who. Good luck with it. So Rexford Industrial creates value by investing in, operating, and redeveloping industrial properties through its infill. Southern California, the world's fourth largest industrial market, consistently the highest demand, lowest supply. Okay, so are these guys a REIT? Yeah, they're a REIT for industrial. They're located in Los Angeles. I'm near Los Angeles, so I agree. There's a lot of industries in Los Angeles. So what's exciting is, like, a lot of properties get repurposed. Like, it used to be a factory. Like, there's a very successful shopping center that used to be a Uniroyal tire factory, and it's called the Citadel. Very successful. They took that property, turned it into shopping. It's one of the most, valuable, popular shopping centers in Southern California. It's right off the freeway. It's perfect. So that kind of thing is exciting. $9 billion in market cap, revenue $936 million. Forward P of 31, pays a dividend of 4.2%. We'll look at funds from operations from this company. It's down 24%, down 19% over the 5-year. Is this undervalued? Analysts believe it is. It's being discounted by 23%. When we look at their top line revenue, has been growing nicely. Nice growth. And revenue growth is 17%. Okay. So when we look at, so earnings per share has been growing, net income growth. I mean, I'm seeing a lot of good things here. So revenue is growing, profitability is growing. So funds from operations, they were for 2023, they paid out 63%. Funds from operations 475. That looks good, but why am I not seeing anything for 2024? See if the quarterly gives me anything. Yeah, funds from operations looks good. Okay. And they're paying out 63%, which is fine. They could probably increase the dividend rate. This one looks interesting. I think I'm seeing some good things, which is top line revenue growth, expanding profits. They have a good idea. They're in a market. Southern California is huge. Second biggest city in the United States. It's a very diversified economy. We have everything. We have entertainment, industrial, distribution. We're one of the leaders in distribution for the US. So this isn't a bad idea. I'm gonna do some homework on this one. I think I'm seeing a lot of positives, and I think I agree with analysts that hey, this thing could be discounted, and it's not a bad real estate investment trust to consider. Real estate investment trust, I don't expect they're gonna like, again, be the next Palantir. No, but it's just good stable gains. This one here has been discounted over the last couple of years, and I'm looking at it going. So you have a president that is really uh, encouraging businesses to make more products in the United States, and kind of make it harder to import things. And if if that's going to be the goal, or I should say, if there's going to be a lot of encouragement to make products domestically, then a stock like Rexford is going to do well because, hey, we were thinking of not expanding our facility here in, you name the city in Southern California, because we were going to source some of our product from China or some other place. But now that we have higher tariffs, the economics aren't looking great, and that might even get worse if the tariff war escalates. So I think we should, that company might expand their capacity in the United States. And if they're in Southern California, maybe they start another factory locally. And all the growth is happening away from the coast in what we call the Inland Empire. And it is booming out there. Amazon's out there big. Everybody's out there that is importing and manufacturing. So I'm liking this stock. I think high level, big picture makes a lot of sense. Fundamentals look good. Company has been growing, small cap. And this one here can really be a nice addition to a portfolio. REITs are not going to, again, they're not going to, triple in value over the next 5 years, but I think they could deliver a really nice rate of return. And the risk is relatively lower than a regular stock because they have hard assets behind the company, meaning they own real estate that's valuable. Worst case scenario is they can sell some real estate to, recover from some losses. And real estate continues to be a necessity no matter what for these businesses. So I like Rexford. It's a good stock, but I have more homework to do on it. I have no price target. I have nothing. So I'll take a look at it and share it on a future live stream, or maybe even create a video. All right, so let's go over PAGs, and then I might need to call it a day. So PAG Seguro doing nicely for the year to date, not so nicely for the 1 year. This is a small cap, 2.4 billion. They do financial and payment solutions for consumers and individual entrepreneurs, micro merchants, small mid-sized businesses in Brazil and internationally. Very good. That's great. All right. Forward P is super low, 6.47. Analysts think it's highly discounted, so 74%. We'll see how many cover this stock. Revenue growth is there, 14%, 18.79 in the most recent quarter. Okay. And this is in the real. And what is the so it's $0.17 per real. So this is probably 1.5, $1.6 billion of revenue, actually operating revenue, but then they have other revenue. So 17, this would be probably about $3 billion of revenue in dollars. They have negative free cash. And I think if we look at the quarterly, let's see. Yeah, it's negative for a couple quarters. If this turns positive again, that's what's going to turn the stock. The stocks have been selling off. Maybe it's just negative cash that's scaring away the market. Gross margins look good. Short sellers are on this stock. 15% of shares are out short. So there might be a little bit of a short squeeze. So revenue is 3.2 billion. Gross profit looks good. This is all US dollars. Balance sheet, not too much debt. $564 million debt, $132 million of cash. Looks good. So this one here is a growth stock. It'd be nice to see them grow faster. They're not the biggest company out there. So if they can get back to growing a little bit, I mean, they are improving at 18.79%. That looks really good. If they come out with an earnings announcement that they grow free cash flow at like near 20% and they flip to positive cash, this stock's going to take off. The stock is sold off quite a bit. So I don't know that it would go down any further unless there's a risk or there's thoughts that they can go bankrupt. Then obviously the stock would really tank. But if they could show positive free cash flow and grow a little bit faster, look out. The stock's really going to take off, is my expectation on PAG Seguro. But their business makes sense. I mean, the whole pain with cash kind of process is, I don't like paying with cash because it's a burden. And I don't think people of all walks of life would prefer just to use a card and just, either a debit card or a credit card. Someday it'll be cryptocurrency and just kind of handle it in a digital format. And these guys bring that type of solution. So that's PAG Seguro. All right. Thanks everybody for watching the live stream. I'm behind on comments. Let me see if I catch up with some comments. Thanks for joining, everybody. So Shadow Guy, yep, you track TLT. Yeah, that's right. The long term, this one. So iShares 20. It's doing well year to date, and dividend at 3.83. Okay. It's down a little bit. Low risk, low rate of return. But again, when we have a portfolio, you don't, in my opinion, I don't put all my stocks in high growth. Hey, it's going to be great, because you could have some years that are great and some years that are horrible. And the horrible years are like, oh my God, I can't spend any money because I'm down so much. I feel bad that I'm selling stock at such a big loss. So instead, you balance your portfolio with some non-risk, low-risk assets. So when you have years like that, you're like, yeah, no problem. I don't change my standard of living. I can spend money because I could spend it off my bond portfolio that doesn't go up or down very much. And in down markets where the stocks are really sold off, bonds tend to really rise. And it's kind of it's a hedge on stocks. So having an investment of this type really makes sense in a portfolio, especially for older investors like myself. So Shadow Guy, I remember, wasn't Snoopy also a mascot for some kind of resort? I know that they were a theme park. What was it? Six Flags or Knott's Berry Farm. They were also they borrowed the mascots to put them around Knott's Berry Farm here in Southern California. Snoopy's in NASA too, man. Snoopy, he's everywhere. Go Snoopy. All right. So Shadow Guy noticed OHI reported good earnings. Hopefully it bodes well for CTRE. I hope so. Very good. And Snoopy we trust. Guglielmo. So do I think Alphabet shares will fall in the future? No. I think Google Alphabet's a really strong company. They have good businesses that just continue to thrive, their search business, their YouTube business. But I would say is Microsoft, Google, and probably AWS, they're getting the message from the market, which is, if you don't show me AI revenue and you keep spending that CapEx, yeah, we're going to take your stock lower because we think you're burning money. You're burning it without delivering value. So I would say that they're getting the picture that you're taking a big risk if you keep spending that rate of CapEx without showing revenues for AI. Merck. You know, let's take a look at Merck, because the one thing, I think I saw something I was concerned about. So revenue's fine. Yeah, I agree with that sentiment. This could be a good buying opportunity. They're down 30%. Historically, they were, priced much higher. And for some reason, like, healthcare has been beaten up, forgotten. Close to 7% growth on a big company, that's really good. And they're very profitable, 80% margins. So I cannot argue with that sentiment that Merck may be a good buy. Golden, New Holdings. How is New Holdings doing? Good for the year. Beautiful. Nice. Looks great. Growing well. They have the attention of the market. Yeah. Loving and you as well. So I have HAFN. Cool. Congratulations. Nice buy. So be ready. Beauty from Elf is coming to us today. Earnings. Oh, wow. Here we go. So Elf has been beaten up. Maybe if Elf announces positive earnings, that stock could really fly up. I don't invest in Elf. It's not my lane. I don't know beauty all that well. All right. So yeah, best of luck, Shadow Guy. I appreciate it. All right, let's take a peek at the market real quick. What's going on, stock market? Looks like some things have left the red zone. Amazon's up. Tesla's up a little bit. Qualcomm's still red. So that's where we're at. Google is still down. Not as bad as yesterday. Man, Meta. Holy smokes. Meta getting it done. That's a big, big cap, man. They're having a really good year. That looks good. And looking at the indexes, flat. S&P's up only 0.14, NASDAQ 0.16, Dow's down a bit. Okay. We're going to have a boring day on Wall Street. All right, everybody. So thanks for tuning in. And hopefully year to date, you're doing well with your stocks. I cannot complain. January was a phenomenal month for me. I had a really, really nice return overall in my portfolio. And I'm kind of building some cash because I'm like, let's kind of bank some of these gains and build up some cash. So I have been building up cash. I sold out of Microsoft. I think I covered the reasons for that. I also sold some shares of some really good holdings, just a couple shares, just to build up some cash. And we'll see if that ends up being a good idea. But carrying a little pile of cash right now, earning 3 to 4% is not a bad idea. I'm still mostly invested. I'm always mostly invested, but I probably like to have, if in a perfect world, to have like 5% of cash. If I'm really nervous, 10% in cash. And right now I'm probably 6% in cash and probably building a little bit more. I am getting nervous because stock values are pretty high and I do have some gains to take. So I will take them early in 2025. And the first month I'm up more than 9%. So I'm like, okay, that's a really good rate of return. I don't think all months are going to be like that, or man, I'll be really happy in 2025. So that's what I'm doing. And individually, you guys kind of follow the stocks that I really am interested in. Later today, Amazon. I think Amazon's going to be an amazing performance, but the market's going to really key in on that CapEx. They're going to be like, hey, are you going to be like Amazon, another amazing business that spent too much on CapEx and then we're going to have to punish you? Are you going to be like Google, a super amazing business that spent too much on CapEx and the market abused that stock price? We'll see. I'll be that'll be the activity of the late afternoon, and I'll take a look at it. Not sure if I'm going to be able to stream, but if I can, I will. And for sure, you'll see a video on Amazon late today. That is one of my bigger holdings, not the biggest one. The biggest one is Meta. Number 2 is Google. And but Amazon's up there. It's top 7 holding for me, and is an important stock in my portfolio. All right, guys. Thanks so much for joining. I appreciate it. Everybody, good luck with your investments. Have a good day.